This is a summary of the book The New Trading for a Living by Dr. Alexander Elder. Imagine losing money in trades because of fear or greed. Now, picture turning that around with simple mind control and smart plans. The New Trading for a Living by Dr. Alexander Elder teaches easy ways to stay calm, manage risks, and build winning habits for real financial freedom. Say goodbye to endless losses and hello to steady gains through practical steps like daily record keeping and clear rules. This updated guide blends old wisdom with fresh tools to solve everyday trading struggles. Unlock your path to independent living anywhere in the world. Let's find out more.
It is a compelling promise, isn't it? That idea of total independence.
It really is. And honestly, when I first started digging into this material, that's exactly where my brain went. I found myself daydreaming about the last frontier. You know, that concept Dr. Elder talks about right at the beginning of the book.
The idea that trading is the final frontier of opportunity.
Exactly. I mean, the image of having no boss breathing down your neck, no rush hour traffic to fight through, no HR department to navigate, just you, a laptop, and the global markets.
Right. Maybe you're sitting on a beach in Thailand, or maybe you're in a cabin in the Rockies. It feels like the ultimate escape hatch from the modern rat race, the ultimate freedom.
It is the ultimate dream for many, and Dr. Elder, he acknowledges that attraction right out of the gate. He calls trading the last frontier precisely because it offers that intoxicating mix of total freedom and unlimited opportunity.
Right.
But we have to ground this conversation immediately because this is where the book takes a sharp, realistic turn. That freedom is exactly what destroys most people.
Because there's no structure. No one telling you when to clock in or what to do.
It goes deeper than just scheduling. Think about it. In a normal corporate job, or even in running a typical brick-and-mortar business, you have massive constraints. You have a boss, you have a set of deliverables, you have legal frameworks, you have social pressure from colleagues.
Of course.
Even the hours are set for you.
Right. You have guardrails everywhere. Exactly. In the market, there are no guardrails. You can wake up at 3 a.m., log into your account in your underwear, and bet your entire life savings on a currency pair you know nothing about.
And no one will stop you.
Nobody will stop you.
Yeah.
And because most amateurs treat this unrestricted environment like a video game, or worse, like a lottery ticket, the failure rate is staggering. Elder's very clear. This isn't a hobby. It's a serious intellectual pursuit.
And that brings us to the really unique angle of this deep dive. Usually when we cover finance or trading books, we're looking at material from, a hedge fund manager, a mathematician, or maybe an economist.
Sure.
But Dr. Alexander Elder has a very different background.
That is the key differentiator for this entire philosophy. Dr. Elder is a psychiatrist. He was working in New York City, actively treating patients, dealing with the complexities of the human mind, all while he was teaching himself to trade.
So he was analyzing patients by day and charts by night.
Essentially, yes. And because of that background, he noticed something profound that most financial pros miss. He realized that the reason traders fail usually has nothing to do with their inability to read a chart or because their computer isn't fast enough.
It's not the hardware.
No, it's the software, the wetware between their ears. His thesis is that the key to winning is inside your mind, not inside the computer. You can have the best trading system in the world, a perfect algorithm. But if your head isn't right, you will sabotage yourself. You will deviate from the plan.
Which is fascinating because usually when you think trading, you think algorithms, quantitative analysis, macroeconomics. You don't think Sigmund Freud. But if we connect this to the bigger picture, it makes perfect sense. What is the market, really? It isn't a physical thing. It's a collection of people.
Right.
Millions of people making decisions based on fear, greed, hope, and regret. Therefore, the market is driven by human psychology. Elder breaks success down into 3 pillars: psychology, market analysis, and risk management. He often uses the metaphor of a 3-legged stool.
If you have the best analysis, let's say you're a technical wizard, but your psychology is weak, the stool collapses.
You'll get scared and sell too early or get greedy and hold too long.
Precisely. You will break your own rules.
So we've got a roadmap for today. We're going to spend a significant amount of time on that psychology, both individual and the behavior of the crowd. We'll look at charts not just as lines, but as pictures of mass emotion.
Yes.
And we'll get into the specific tools he recommends. But before we get to the how-to, we have to talk about the what, specifically the odds.
We do. And this is the cold shower before we get into the warm bath of strategy. We need to talk about the minus sum game.
Okay, let's break this down. I think the average person on the street, they assume trading is a 50-50 shot. The market goes up or the market goes down. You pick right, you win. You pick wrong, you lose. Like flipping a coin.
Simple coin flip, yeah.
But Elder says that's mathematically false. Let's unpack this. What makes it minus sum?
Well, to understand minus sum, we first have to understand zero sum. Think of a friendly poker game in your garage with your neighbors. If I win $100, you lose $100.
Right. The money just moves around the table.
The money just changes hands across the table. The total amount of money in the room stays the same. That is zero sum.
Okay, that makes sense. No money is leaving the ecosystem.
But trading has an entire industry attached to it. Every time you enter a trade and every time you exit a trade, money is drained from the pot. It doesn't go to the other trader. It goes to the house, the brokers, the exchanges, the data providers.
So even if I break even on my trades, buy a stock at $10, sell at $10, I'm actually losing money because of the costs of doing business.
Precisely. You are bleeding capital just by participating. And the drain consists primarily of two things: commissions and slippage.
Commissions I get. That's the fee the broker charges. Although I have to play devil's advocate here. Haven't commissions gone down to almost zero on a lot of platforms these days?
They have dropped significantly for stocks, yes, that's true. But for futures, options, and international markets, they still exist. And even zero commission brokers, you have to ask how they're making money.
Right. There's no free lunch.
They often make money by selling your order flow to high-frequency traders, which can result in a worse price for you, which is a hidden cost. But let's look at Elder's example from the book to illustrate the principle, because the math is startling.
Okay.
He calculates that an active trader with a $20,000 account could easily spend 20% of their equity in a single year just on commissions and fees if they aren't careful.
20%. That puts it in perspective. That means before you even start looking for profit, you have to earn 20% just to stand still. You start the year in a massive hole.
Exactly. That is a massive headwind. Most hedge funds would kill for a 20% return in a year, and you have to generate that just to break even.
Wow.
But the more insidious killer, the one beginners rarely understand until it bites them, is slippage.
Slippage. This is a term I hear thrown around in finance circles, but I feel like people don't really grasp the mechanics. Elder uses an apple analogy in the book that I thought was brilliant.
It's a great simplification. Imagine you go to a grocery store to buy an apple. You see a nice apple, and the sign above the bin says 49 cents. That is the posted price or the last quote on your screen.
Okay.
You decide, okay, I want that apple. That's a fair price. You walk to the counter, but by the time you get there, the clerk says, sorry, lots of people want apples right now. The price just went up. That'll be 50 cents.
So I have to pay a penny more than I thought because the demand shifted in the split second it took me to act.
Right. You pay 50 cents. Then let's say you immediately decide to sell the apple back. You turn around to the clerk and say, I want to sell this. But now he says, well, since I'm buying it back, I can only give you 48 cents for it.
So there's a spread, the bid and the ask.
Exactly. That difference, buying at 50 when you wanted 49 and selling at 48, is slippage. It's the friction of entering and exiting the market.
And a penny or two doesn't sound like much.
It doesn't until you multiply it by volume. If you're trading 1,000 shares, a penny of slippage is $10. If you slip on the entry and the exit, that's $20 gone, plus your commission.
Right.
Elder says slippage is often 3 times worse than commissions because it's invisible until the trade is done. It's the vig that you don't see coming.
So the game is structured against you?
He compares it to a casino. In roulette, the house has the 0000, at least in American roulette. That green slot gives the house a statistical edge of roughly 5.26%.
Right. The house always wins.
In trading, the commissions and slippage are the 000. To win, you don't just have to be better than the other traders. You have to be better than the crowd plus the house cut.
That is a sobering reality check. But there's another layer to this industry he warns about, the sword makers. This felt a bit cynical, but probably necessary.
It's very necessary. He uses the metaphor of medieval knights going into battle. The traders are the knights. They're the ones risking their lives or their capital on the field. But lining the road to the battlefield are the merchants, the sword makers.
These are the people selling the software, the proprietary indicators, the expensive seminars, the hot tip newsletters.
And the book's elder is self-aware enough to include himself in this ecosystem, though he tries to be an honest merchant. His point is that the sword maker gets paid whether the knight lives or dies.
Right.
The vendor selling you a $3,000 trading computer or a guaranteed signal service makes their money up front. They don't care if you lose your account next week.
It's the classic selling shovels in a gold rush.
Exactly. And the takeaway here is vital for any listener thinking about trading. You cannot buy success. You cannot buy a magic sword that'll make you a great trader. You can only earn it through personal development.
Which brings us squarely to that personal development. Let's move into segment 2, individual psychology. Because if the game is already hard mathematically with the minus-sum aspect, Elder argues we make it impossible emotionally.
Emotional trading is lethal. That is the core tenet of the psychiatric approach to markets.
He uses this really vivid image to explain how we react to pain. The monkey and the tree stump.
It's a brutal analogy for revenge trading, but it sticks with you. Imagine a monkey walking through the forest. It stubs its toe on a sharp tree stump. It hurts.
Yep.
Now, a rational being, let's say, a human who is thinking clearly, would nurse the wound, maybe put a bandage on it, and walk around the stump next time.
Sure, makes sense.
But the monkey is primitive. It gets angry.
It blames the stump.
It flies into a rage. It kicks the stump to punish it, which of course hurts the monkey's foot even more.
And now the monkey is in even more pain and even angrier.
Correct. And now in severe pain and blind fury, the monkey might even smash its head against the stump. Elder argues that traders do exactly this.
How so?
They take a loss, which is just a stubbed toe, a part of doing business. But they take it personally. They feel the market stole from them. They get angry.
I can see that.
They try to get their money back immediately by doubling down or taking a high-risk trade. They kick the stump. And that is how they destroy their accounts.
I think everyone who has ever traded has had that monkey moment. You just see red. You feel like the market is personally attacking you.
And that feeling of personal attack, or that inability to stop, leads to the most famous concept in the entire book. Dr. Elder takes the principles of Alcoholics Anonymous AA and applies them directly to trading.
This blew my mind. I mean, treating trading losses like alcoholism, that feels extreme. But when you read the breakdown, it clicks.
It connects because the psychological mechanism is the same, the loss of control. An alcoholic cannot control their drinking. They might start with one drink, but they can't stop.
Right.
A losing trader cannot control their losses. They keep saying, I'll stop after this one, or I can handle it, or the market is bound to turn around.
Denial.
Pure denial. So in AA, the first step is admitting you are powerless over alcohol. What is the first step for a trader?
Admitting you are a loser?
It sounds incredibly harsh. Good morning, my name is John, and I'm a loser.
It feels like it would destroy your confidence. Don't you need confidence to trade?
You need confidence in your system, not arrogance about your ability to predict the future. By standing in front of the mirror and saying, I am a loser, you are admitting that you have the potential to lose.
I see.
You are admitting that you are not bigger than the market. You are admitting that if you let your emotions take over, you will lose.
So it cuts the ego out of it. It's an act of surrender.
Exactly. If you think you are a winner who can do no wrong, you get arrogant. You ignore stop losses. You bet too big because you know it's going up.
Right.
But if you admit, I'm a loser who needs strict rules to survive, then you focus on risk control. You start driving defensively.
It's a mindset shift.
Just as an alcoholic hits rock bottom before recovering, many traders lose their entire account, their financial rock bottom, before they finally accept they need discipline. Elder is trying to help you find that discipline before you lose the house.
It's shifting the mindset from how much can I win to how do I not lose?
That is the pivotal shift. Amateurs focus on the upside. Professionals focus on the downside.
Now, part of this psychology section also deals with fantasies. We touched on the last frontier fantasy, but he goes deeper. He talks about the autopilot fantasy. This seems to stem from a desire to be taken care of.
It's actually a regression to childhood.
Yeah.
Think about an infant. An infant is passive. The mother feeds it, keeps it warm, rocks it to sleep.
Okay.
The autopilot fantasy is the trader wanting the market to be their mother. They want a black box system, a magic computer program where they can just curl up, go to sleep, and have a stream of warm milk profits flow into their mouths without any effort.
Passive income, set it and forget it, all those buzzwords.
But the market is not your mother. It's a battlefield. If you are sleeping, someone is picking your pocket.
Then there's the other side of the coin. If the autopilot is the mother figure, he talks about the guru as the father figure.
The little Stalin. We crave a strong leader, someone to tell us exactly what to do. Buy this stock now, sell that crypto now.
Yeah, you see that all over social media.
We want to abdicate responsibility. Because if the guru is wrong, it's his fault, not mine. I don't have to feel the shame of the loss.
But Elder says true success requires total independence.
Absolute independence.
Yeah.
You have to accept that the market is dangerous, potentially hostile, and you and only you are responsible for your safety. No guru will save you. No black box will save you. You have to save yourself through discipline and your own plan.
That is a heavy realization, but an empowering one. Okay, so we've got our own heads straight. We're admitting we're losers. We're cutting out the fantasies. Now we look at the screen. And what do we see? Segment 3, mass psychology.
We see the crowd.
The market isn't a thing. It's a mob.
It is a huge global mass of people, and Elder leans heavily on classic social psychology here, referencing Gustave Le Bon and others who studied mob mentality. He points out that while individuals can be smart, rational, and calm, crowds are primitive.
Primitive how?
They are emotional. They are not smarter than the individual. They are dumber.
The collective IQ drops.
It drops significantly. Crowds swing from fear to greed and back again with no middle ground. Think of a riot or a football stadium during a winning goal. The emotion sweeps through the group.
Right, mob mentality.
In the market, that emotion is represented by price. Elder says price is the leader.
The Pied Piper.
Yes. Imagine the price of a stock is ticking up. That uptick is the Pied Piper playing a tune. The crowd sees it and gets greedy. Oh, it's going up. I need to join. I'm missing out. So they buy, which pushes the price higher.
The fear of missing out, FOMO.
Exactly. The piper plays louder. More people join. It becomes a feedback loop of greed.
Until the music stops.
So the trend reverses. Maybe a big seller steps in. Then the crowd panics. And remember, fear is a much stronger emotion than greed. They trample each other trying to get to the exit.
So when we look at a chart, we aren't looking at lines. We are looking at a map of crowd behavior.
A technical analyst is, in Elder's words, a for-profit social psychologist. You are not analyzing the company's earnings or the crop report. That's fundamental analysis. You are analyzing how the crowd feels about those things.
You're reading the room.
You're measuring the strength of the bulls versus the bears.
Let's define those terms because he gives them a specific flavor. Bulls and bears. It's not just animals.
Think of them as armies. Bulls are buyers. They bet on the rally. They want to push prices up. Bears are sellers or short sellers. They bet on the decline. They want to push prices down.
A constant battle.
It is. Prices rise when the bull army is feeling aggressive and willing to pay more, and the bear army is fearful or holding back.
Yeah.
Prices fall when the bears are aggressive and the bulls are afraid.
And what determines the actual price we see on the screen?
The consensus of value. This is a key definition. At any given moment, the price on the screen is the only price where a buyer and a seller agree to do business. It is the momentary truce between the two armies.
So if I'm a trader, I'm basically a war correspondent trying to figure out which army is winning the battle.
Yes, but with one crucial twist. You must be a contrarian.
Independent. Go against the crowd.
When the crowd is screaming with greed and the trend is vertical, the professional is looking for the exit. He is selling to the greedy crowd who are arriving late.
And vice versa.
When the market is crashing and the crowd is vomiting up their positions in terror, the professional is stepping in to buy. You must stand apart from the crowd to profit from it.
That is easier said than done. It's hard to stand in front of a stampede. Evolutionarily, we are wired to run with the herd, not against it.
Which is why we need tools. We can't just rely on our gut because our gut will want to join the crowd. We need objective measures. This brings us to segment 4, classical chart analysis.
Okay, charting. Support, resistance, head and shoulders, triangles. This is what most people think of when they think technical analysis.
It is, but Elder gives a very specific warning here. He compares classical charting to a Rorschach test.
The ink blot test.
Exactly. You look at an ink blot, you see a butterfly, I see a bat. Who is right?
Neither of us. We're just projecting.
Right. Classical charting is subjective. If you are feeling bullish, maybe you just got a bonus at work and you want to buy that, you will look at a chart and see a bullish pattern. You will subconsciously ignore the bearish signs. You project your hopes onto the chart.
So he's skeptical of the complex patterns like pennants and wedges.
He is skeptical of anything that relies too much on the eye of the beholder. However, he does believe strongly in support and resistance, but he defines them psychologically.
They aren't just lines on a graph where the price stopped. They are memories.
They are memories of pain and regret. Let's break down support. Imagine a stock falls to $50 and then bounces back up to $60. That $50 level is now support. Why?
Because people remember it bouncing there.
Specifically, 3 groups remember it. First, the bulls who bought at $50. They made money. They feel smart. But they probably wish they bought more.
So they want to buy again if it gets back there.
If it goes back to $50, they want to double down. That's buying pressure from the winners.
Right.
Second, the bears who sold or shorted at $50. They are in pain. They sold at the bottom. The stock is now at $60, so they are losing $10 a share. They are praying for it to go back to $50 so they can cover their shorts and get out break even.
So they become buyers at $50?
They become buyers at $50 to close their position. That's buying pressure from the losers.
And the third group?
The people who did nothing. The undecided. They saw it bounce, and they regret missing the boat. They tell themselves, if it ever gets back to $50, I'm buying this time.
So all three groups, the winners, the losers, and the undecided, have a vested interest in buying if the price returns to $50.
Exactly. That collective desire creates a floor under the price. That is support. And resistance is the opposite. It's a ceiling created by the pain of bulls who bought at the top and are now trapped, and the regret of bears who didn't sell enough.
And the more times a level is hit, what happens?
It gets stronger initially because the memory is reinforced. But eventually, if the crowd keeps hammering at a door, it'll break. But understanding that these lines represent pain helps you trust them more than just drawing random diagonals.
Now, you mentioned he likes objective patterns. One of his favorites is the kangaroo tail. I love the name, but what does it look like?
It's a very visual pattern, often seen at market turning points. Imagine a cluster of price bars just moving sideways, a tight range.
Okay.
Then suddenly, one bar shoots way out, maybe way up during the day. It looks like a breakout. The crowd gets excited. But then by the end of the day, the price collapses and snaps back to close inside the original cluster.
So it looks like a long tail hanging out of the chart.
Yes.
Yeah.
Think about the psychology. What does that tell us about the crowd? It tells us the bulls tried to push prices up. They got super excited, but they failed.
They ran out of steam.
They ran into a wall of selling. The bears slapped them back. That failure is a very strong signal that the bulls are exhausted and the market is about to reverse in the other direction. It's a trap that has been sprung.
That makes sense. It's a failed breakout.
Yeah.
Okay, moving on to segment 5. While Elder respects support and resistance, he seems to prefer tools that are less open to interpretation. Computerized technical analysis.
He does. In the debate between subjectivity and objectivity, the computer wins. An indicator is purely mathematical. It is either pointing up or it is pointing down. You can't argue with it.
It removes the wishful thinking.
To an extent. You still have to interpret it, but the data is hard. Now, he distinguishes between toolboxes and black boxes.
A toolbox is what pros use.
A toolbox is software that lets you see the data, apply indicators, and adjust the parameters. You are the craftsman. The software is the hammer and saw. You know exactly how the indicator is calculated.
A black box.
A black box is that fantasy we talked about. A secret code that just says buy or sell without telling you why. Elder says avoid black boxes like the plague. They're usually scams or curve-fitted nonsense that work on past data but fail in the future.
Let's look at the tools in the toolbox, the grandfather of them all, moving averages.
A moving average, or MA, is essentially a composite photograph of the market. It smooths out the noise to show you the trend. But Elder has a strong preference here. Avoid the simple moving average, SMA, and use the exponential moving average, EMA.
Why? What's wrong with the simple one?
The barking dog problem. This is a classic Elder teaching moment.
Do tell.
A simple moving average takes the last, say, 10 days of prices, adds them up, and divides by 10. Every day, it drops the oldest day and adds the new day.
Okay.
Now imagine 10 days ago, there was a huge price spike, a really high number. Today, that high number gets dropped from the calculation. Even if the market does nothing today, price is flat, the moving average will suddenly drop because that high number fell off the back end.
So the indicator changes not because of what's happening now, but because of what happened 10 days ago?
Exactly. It's like a guard dog that barks when a burglar enters your yard, the price spike, but then barks again 10 minutes later when the burglar leaves. It gives you a false signal. It's barking at old news. The exponential moving average, EMA, solves this by giving more weight to the most recent data. It doesn't drop old data abruptly. It lets it fade away over time. It's much more responsive to the now and eliminates the barking dog.
Okay, so stick to EMAs. And he uses these to define value. We talked about the consensus of value, but how do we see it on the chart?
He draws a value zone. This is the space between a fast EMA, say a 13-day, and a slower EMA, say a 26-day. He argues that this zone represents the fair price.
And the strategy is, don't buy when the price is far away from the EMA.
Exactly. Think of the price like a dog on a rubber leash, and the EMA is the owner walking down the street. The dog can run ahead or lag behind, but eventually the rubber leash will pull it back to the owner.
Right.
If the price shoots way above the moving average, the market is overextended. The rubber band is stretched. If you buy there, You are buying at the top of the crowd's excitement. You want to wait for the price to pull back into the value zone. You want to buy value, not hype.
Buy the dip, essentially.
But specifically, buy the dip to the EMA. It provides a disciplined entry point.
Got it. Now, moving averages follow trends. But what about when the market goes crazy, the emotional extremes?
That is where oscillators come in. Things like the RSI or Relative Strength Index or Stochastic. These indicators measure the speed of the crowd.
The speed.
Think of a car accelerating. An oscillator measures how fast that car is going. When the crowd goes into a frenzy buying everything in sight, the oscillator reaches an overbought level. It's like the engine redlining.
And that means a crash is coming?
Not necessarily a crash, but it means the car cannot sustain that speed. It needs to slow down or pull over. The most powerful signal Elder looks for with oscillators is divergence.
Explain divergence.
This is when the price keeps going higher, the car is still moving forward, but the oscillator starts dropping. The engine is losing power. Imagine the price makes a new high, but the indicator makes a lower high.
So the momentum is gone, the crowd is exhausted.
Exactly. They are still pushing price up out of habit or inertia, but the emotional intensity is fading. The smart money has stopped buying. That is the moment the professional steps in to bet on the reversal. It is one of the strongest signals in technical analysis.
It's fascinating how he ties everything back to the crowd. It's not just lines crossed, it's the crowd is exhausted.
Always. If you lose sight of the people behind the chart, you lose your edge. The chart is just a shadow of the crowd's behavior.
Speaking of people, let's talk about the energy of the crowd. Segment 6, volume and time.
Volume is the steam that makes the train go.
I like that. You can have a train sitting on the tracks. That's price. But without steam volume, it's not going anywhere.
Correct. Volume measures the emotional intensity of the players and the amount of money changing hands. If prices are rising and volume is rising, it means new people are joining the crowd. The trend is healthy. The steam is building.
But what if prices rise and volume is low?
That's a hollow rally. It means the professionals are sitting on their hands. It's just a few amateurs pushing the price around. If there is no volume, there is no conviction. That trend is likely to collapse because there is no fuel behind it.
He mentions a specific tool for this. On-balance volume or OBV?
This is a classic tool. It's a running total. If the market closes higher today, we add today's volume to the total. If it closes lower, we subtract it.
Okay.
It creates a cumulative line on your chart.
Yeah.
What's fascinating is that OBV often acts as a leading indicator. The smart money, the institutions, often start buying quietly before the price moves up. They're accumulating. You'll see the OBV line start to rise while the price is still flat.
It's like seeing the steam build up before the wheels start turning.
Exactly. It reveals accumulations like X-ray vision into the market's tank.
And Dr. Elder created his own indicator here, right? The force index.
Yes. He wanted a single tool that combined price and volume. The formula is elegantly simple. Today's close minus yesterday's close, multiplied by today's volume.
So, direction of the move times the extent of the move times the volume.
Right. If the market moves up a huge amount on huge volume, the force index is a giant positive DAR. The bulls are incredibly strong. If the market moves up but on tiny volume, the force index is small. It tells you the bulls are weak. It's a very sensitive way to measure the actual power behind a move.
I want to pivot to the final major technical concept, time. This is the one that confuses me the most. You look at a daily chart, it says buy. You look at a weekly chart, it says sell. Which one is right?
This is the factor of 5 dilemma, and it stops many traders in their tracks. They get paralyzed by conflicting signals. Elder explains that markets exist in multiple time frames simultaneously, but you cannot just pick one. You need context.
So how do we resolve the conflict?
With the rule of 5. He observed that time frames usually relate to each other by a factor of roughly 5. There are 5 trading days in a week, so the weekly chart is the bigger brother to the daily chart.
I see.
There are roughly 5 or 6 hours in a trading day, so the daily chart is the bigger brother to the hourly chart.
Okay, so the rule is to look at your main time frame and then multiply by 5.
Yes. If you like to trade off the daily chart, that's your intermediate time frame, you must look at the weekly chart, your long-term time frame.
And what are we looking for?
Strategic direction. The long-term chart decides the strategy. The intermediate chart decides the tactics. If the weekly chart is in an uptrend, you are only allowed to buy. You cannot go short.
Even if the daily chart looks like a sell?
Even then, if the weekly is up, you ignore sell signals on the daily. You wait for the daily to dip and give you a buy signal. You only trade in the direction of the tide.
The tide and the wave.
That's the metaphor. The weekly is the tide. The daily is the wave. You never swim against the tide. You use the wave, the daily chart, to get a good entry point into the tide, the weekly trend.
This basically solves the triple screen system he talks about, doesn't it?
It is the foundation of it. Screen 1, the tide, the weekly, to make a strategic decision, buy or sell. Screen 2, the wave, the daily, to find the setup. And screen 3 is the entry technique. It forces you to be disciplined.
Right.
It forces you to look at the big picture before you zoom in.
And it stops you from getting tunnel vision on one chart.
Correct. Tunnel vision kills traders. You zoom in on a 5-minute chart, you see massive downtrend, you sell. And 5 minutes later, you get run over because the weekly chart is in a massive bull run. Context is everything.
So what does this all mean? We've covered a lot of ground here. We started with the dream trading from a beach.
And we immediately hit the reality. The minus-sum game, the industry drains, the emotional trap of the loser mentality.
We learned that we have to govern our own minds first. We have to admit we are losers to become winners. We have to ignore the little Stalins and take responsibility.
Then we looked outward. We realized the market is just a crowd. We learned to analyze that crowd using objective tools, EMAs, force index, OBV, rather than Rorschach tests.
And finally, we organized it all with time, the factor of 5, using the long term to set the strategy and the short term to pull the trigger.
It is a complete ecosystem. But if I can leave the listener with one thought, it is this. Knowledge is only potential power. We have discussed the market analysis pillar today. We touched on the psychology pillar. But the execution, the actual act of placing the trade and honoring the stop loss, that is where the rubber meets the road.
The market is not your mother.
It is not. It is a battle. You are a knight. We've discussed the sword and the shield today, but you are the one who has to swing it. You have the map now. The question is, do you have the discipline to follow it when the monkey wants to kick the stump?
That's the real challenge. It's not about being smart. It's about being disciplined.
Discipline is the only thing that separates the professional from the gambler.
Well, this has been an incredible deep dive into Dr. Alexander Elder's classic. I feel like I need to go apologize to a few tree stumps in my backyard.
Just don't kick them.
Deal. Thank you for watching. Please like, share, subscribe, follow up in next topic.
Come back to continue the new trading for a living. It is great to have you back with us. Today feels like we are turning a really significant corner in our exploration of Dr. Alexander Elder's work.
It really does. It feels like we're finally moving from the classroom to the workshop.
Exactly. If you were with us for the last deep dive, we spent a lot of time in the trader's head. We talked about psychology, the inner demons, the discipline, the whole Alcoholics Anonymous approach to loss.
All incredibly important stuff, the internal game.
Absolutely. It was fascinating, but it was very internal. It was all about what's happening between your ears. Today, we are getting our hands dirty. We are looking at the practical application.
That is the perfect way to frame it. We are shifting from the internal world of the trader to the external reality of the market. Because here's the hard truth, and it's one that Dr. Elder just hammers home again and again.
Which is?
You can have the most disciplined mind in the world. You can be as cool as a cucumber. You can have the psychology of a Zen monk. But if you don't understand the machinery you're operating,
you're still going to lose.
You're essentially a very calm person about to lose a lot of money. And, that's not what we're here for.
Which is definitely not the goal.
Yeah.
We want to make money, not just be zen about losing it. So the mission for this deep dive is pretty specific. We want to distill the hard rules. And I want to emphasize that word rules. Dr. Elder isn't giving us vague guidelines here. He's giving us the nuts and bolts, the machinery of trading.
He calls it the machinery for a reason. It's about structure. It's systematic. We aren't guessing. We are not, feeling our way through the dark.
No more intuition-based trading.
Oh, none of that. We're going to look at how to analyze the crowd using indicators, how to build a specific trading system, specifically his famous triple screen system, how to choose what to trade, and then, crucially, how to survive the inevitable hits.
Survive the hits. I like that.
Yeah.
So let's unpack this. We're starting with what the outline calls the macro view, general market indicators.
The big picture.
And I have to ask the obvious question first, because I think a lot of newer traders get stuck right here. If I find a stock I love, let's say I've done my research on a specific tech company. The earnings are good, the chart looks great, the CEO is a genius. Why do I need to care about the market as a whole? Why can't I just trade the stock?
It's such a fundamental question, and it's a very common mistake. It's tunnel vision.
Right. You get fixated.
You see a perfect setup on a specific chart and you totally ignore the environment it's sitting in. You're looking at a tree and ignoring the forest fire that's closing in all around it.
That's a strong image.
Dr. Elder puts it very bluntly. General market trends are responsible for as much as half the movement in individual stocks.
Wait, say that again? Half.
As much as half, yes.
That seems incredibly high. You really think the broad market dictates 50% of a stock's move?
It is huge, but think about the physics of it. He uses the classic adage, a rising tide lifts all boats.
Okay, sure.
If the broad market, the S&P 500, the Dow, whatever you follow, is dumping, the tide is going out. Even a really strong swimmer, a strong stock, is going to have a very, very hard time swimming against that current.
So you might be right about the company.
You might be right about the company, its earnings, everything, but you're wrong about the timing because the market just drags it down.
And the opposite is true too, I imagine.
Absolutely. In a roaring bull market, even mediocre stocks get pulled up. The tide is coming in and all the boats are rising. So before you even look at your specific target, you have to look at the ocean. You have to ask, is the tide coming in or is it going out?
Okay, so we need to know the state of the tide. And Dr. Elder gives us a few specific tools for this, and he uses this great military analogy that really stuck with me.
Oh, yeah, it's a great one.
He talks about officers and soldiers. It really helps visualize what the market is actually doing under the hood, doesn't it?
It's a brilliant way to visualize market breadth. Because you can look at the index itself, say the S&P 500 price chart, and that tells you what the market is doing on the surface. That's the headline news.
What you see on TV.
Exactly. But these indicators, they tell you what's happening underneath. The first one he highlights, and he really, really swears by this one, is the new high, new low index, the NHNL.
And this is what tracks the officers.
Correct. The officers are the leaders. These are the stocks that are breaking out to new highs for the year. They are the strongest stocks, the ones leading the charge. They're the first ones over the hill.
And on the other side.
On the flip side, the stocks falling to new lows are the leaders in weakness. The NHNL index isn't looking at price specifically. It's a head count. It simply measures the difference between the number of stocks making new highs and the number making new lows on any given day.
So in a healthy army, a healthy bull market, you want to see the officers leading the charge. You want more new highs than new lows.
Yeah.
Simple as that.
Exactly. You want that number to be positive, and ideally, you want it to be rising. Elder considers this the best leading indicator of the stock market. If the line is above 0 on the chart, it means there are more leaders moving up than down. The bulls are in charge.
And if it's below 0?
The bears are in charge. That's the classic read. But where it gets really fascinating and where you get that aha moment as a trader is when you see a divergence.
Okay, divergence is a word that comes up a lot in technical analysis. Can you break down what that looks like in this specific context? Because I think people hear divergence and they just nod their heads, but they don't visually see it.
Sure. Let's paint a picture. Imagine the S&P 500 hits a new peak. The price is higher than it's ever been.
Everything looks great on the surface.
Everything looks great. The news is cheering. The TV anchors are celebrating. Your neighbor is talking about how much money they just made. But you look at the NHNL index and you see that it's traced a lower peak than it did the last time the market rallied.
So let me get this straight. The market price is higher, but fewer stocks are actually making new highs.
Precisely. The officers are starting to defect, the leadership is thinning out, the index is rising, but it's being pushed up by a smaller and smaller group of stocks, maybe just a few mega-cap tech giants.
While everyone else is falling behind.
That is a massive, massive warning sign. It's like an army claiming victory while its generals are quietly retreating. The collapse usually follows soon after.
He mentioned historical examples, right?
He does. It happened in 1929. It happened in 2007. The generals left the field before the battle was officially declared lost. It's an early warning system.
That is a really clear visual. It's the difference between a broad advance and a hollow one. So the NHNL watches the leaders, the officers. Then he has another metric for what he calls the consensus of value.
Right.
This is the stocks above 50-day moving average.
Right. This one tracks the rank and file a bit more, you could say. The 50-day moving average is a pretty standard proxy for the intermediate trend of a stock. If a stock is trading above that line, it's generally considered to be in an uptrend. If it's below, it's struggling. This indicator just counts what percentage of all stocks in the market are currently trading above their 50-day average.
What I found interesting here were the specific numbers he threw out. It's almost counterintuitive.
It is.
You'd think in a great market, you want 100% of stocks to be rising. You want everyone at the party. But he says that's actually a sign of danger.
It is completely counterintuitive for a beginner. He notes that this indicator usually tops out near 75% and bottoms out near 25%.
So 75 is the ceiling.
Pretty much. If 80 or 90% of stocks are above their moving average, the market is incredibly overbought. Think about it. Everyone who wants to buy has already bought. There is no fresh capital on the sidelines to push prices higher. It's saturated.
There's no one left to convince.
Exactly. So you actually look for reversals at these extremes. If it hits 80% and starts to turn down, that's a sell signal.
Because there's nowhere to go but down. It's like a crowded elevator. Everyone's already on.
Precisely. And if it drops to 25% or lower, that's when things are washed out. It's oversold. The panic has happened. That's often a great time to start looking for bargains because the rubber band is stretched as far down as it usually goes.
It measures the extension of the market's optimism or pessimism.
That's a great way to put it.
Got it.
Yeah.
So we have the officers with the new highs, the consensus with the 50-day MA, and then we have the soldiers, the advanced decline line.
This is the mass participation index. The AD line is simple. It tracks the number of stocks that closed higher versus lower on any given day. It's a cumulative line, so it keeps a running tally. It tells you, are the troops following the generals?
And the logic here is that a rally needs mass participation to sustain itself. If only a few big stocks are moving, it's not real.
Exactly. A rally led by just a few tech giants, while the rest of the market is flat or falling, is what he calls a hollow rally. It's fragile. If the S&P 500 rises but the AD line is falling, that's another classic divergence. It means the soldiers are deserting, even if the flag is still flying high on the hill.
So you need everyone on board.
Broad-based rallies have staying power. Narrow rallies do not. You always want to trade in the direction of the mass participation.
So practically speaking, if I'm sitting down on a Sunday night getting ready for the week, I should look at these three things first.
Yes. Before you look at a single stock chart, check the NHNL to see if the leaders are strong. Check the 50-day MA percentage to see if the market is overbought or oversold. And check the AD line to see if the broad market supports the trend.
It's your weather report.
It is your weather report. Once you know the weather, then and only then do you decide if you want to go sailing.
Okay, so that's our macro view. We check the weather before we launch the ship. We know if the army is advancing or retreating. Now, let's talk about the ship itself, the trading system. This is segment 2, the how-to. And Dr. Elder introduces something called the triple screen trading system.
This is really the centerpiece of his technical method. And honestly, if you take one single technical concept away from Dr. Elder, let it be this one.
That's a strong endorsement.
It was developed to solve a very specific problem that frustrates almost every trader, especially beginners.
Which is that indicators lie, or at least they argue with each other all the time.
They argue constantly. It's maddening. You look at a trend-following indicator, like a moving average, and it says buy because the trend is up. Then you look at an oscillator, like RSI, and it says overbought, sell.
And then you look at a different time frame.
And you look at a daily chart and it says up, but the weekly chart says down. Which one do you believe? It leads to what they call analysis paralysis.
I've definitely been there.
Yeah.
You have 5 different signals pointing in 5 different directions, so you do nothing. Or worse, you guess. You flip a coin.
Right. And guessing is how you lose money. So the triple screen system is designed to filter out those disadvantages. It acknowledges that markets are complex and move in different time frames simultaneously.
It's not about finding one magic indicator.
Not at all. It's about structuring your view of the market. And the core concept here is the factor of 5.
The factor of 5. This is about relating different time frames to each other, right?
It is. Elder says you shouldn't just look at one chart. That's like driving with one eye closed. But you also shouldn't look at 2 charts that are too close together.
Like a daily and a 2-day chart.
Exactly. If you look at a daily chart and a 2-day chart, they tell you pretty much the same thing. They are redundant. He suggests a ratio of about 5 between the time frames you analyze.
So give us a concrete example. If I'm a swing trader and I like looking at the daily chart to make my trades, what does the factor of 5 tell me to do?
It tells you that before you are even allowed to look at your daily chart, which is your intermediate time frame, you must go out 1 order of magnitude larger. There are 5 trading days in a week.
So, the weekly chart.
So you must start with the weekly chart. That is your long-term time frame.
And if I was a day trader looking at a 5-minute chart.
Then you'd multiply by 5-ish. You'd look at a 30-minute chart as your long-term visibility. The rule is simple. Make your strategic decision on the long-term chart and your tactical decision on the intermediate chart.
Strategic versus tactical. I like that distinction. It's like the general decides where to attack and the colonel decides how to attack.
Precisely. The general, which is the weekly chart, doesn't care about the potholes in the road. He cares about the direction of the war.
Okay, let's walk through the 3 screens step by step. Screen 1, he calls it the tide.
Screen 1 is the weekly chart, assuming you trade daily. This is the strategic decision. You use a trend-following indicator here. Elder prefers the MACD histogram or the slope of an exponential moving average, an EMA. The goal here is solely to identify the direction of the tide.
And this leads to a hard rule, right? This isn't just a suggestion.
It is a hard, non-negotiable rule. If the weekly trend is UP, meaning MACD histogram is ticking up, or the EMA is rising, you can only go long or stand aside.
That's it. Those are the only 2 choices.
That's it. You are forbidden from shorting. Even if the daily chart looks like a great short, even if the news is bad, you don't do it. You do not fight the tide.
That requires some serious discipline. Because sometimes the counter-trend moves look so juicy. You see a stock that's run up and you just want to short it.
They do, but they are dangerous. They're suckers' bets. They are short-lived. By trading with the weekly trend, you have the wind at your back. If you make a mistake on your entry, the rising tide might just bail you out.
Okay.
But if you fight the tide and you make a mistake on your entry, you drown quickly.
And if the weekly trend is down, the tide is going out.
Then the rule is just the opposite. You can only go short or stand aside. You ignore all bias signals on your daily chart. It's that simple. This one filter gets rid of so many bad trades. You are always trading with the momentum of the bigger picture.
I love that discipline. It takes away half the choices immediately. So let's say our weekly chart is bullish. The tide is rising. Now we move to screen 2, the wave. This is our daily chart.
Right. Now we zoom in. Since the weekly is UP, we are only looking for buying opportunities. But, and here's where it gets really interesting, we don't just buy because the trend is up. We want value.
We're trying to buy low, sell high.
Exactly. So on screen 2, the daily chart, we use an oscillator. Elder likes the force index or stochastic or Williams per SAR. We are looking for the wave that goes against the tide.
So let me get this. In a weekly uptrend, we are actually hoping for a daily decline. We're waiting for the price to drop.
Yes. That's the counterintuitive genius of it.
Right.
You are waiting for that daily oscillator to drop into oversold territory. You want a temporary pullback. That's your setup. The mantra is buy weakness in an uptrend.
Which is the opposite of what most amateurs do.
Completely. Most amateurs chase the price. They buy when the daily chart is skyrocketing because they have FOMO, fear of missing out.
When there.
The triple screen trader waits for the daily chart to dip, knowing that the powerful weekly tide will likely pull it back up again.
That requires patience. A lot of patience. Just sitting on your hands while the market drops, waiting for your spot.
Incredible patience. But it gives you a much better entry price and a tighter stop loss. You're buying at a discount. You are buying when the weak hands are panicking and selling.
Okay, so weekly is up. Daily has dipped. We have a setup. We're ready to pounce. Now, screen 3, the ripple, or the entry. Do we just hit the buy button the moment the oscillator says oversold?
Not yet. We need confirmation. Screen 3 is about the specific execution. It's often done on the daily chart or even a smaller time frame if you want to be really precise. The technique Elder recommends is using trailing stops to enter the trade.
How does that work for entering a trade? I usually think of trailing stops for exiting, for protecting profits.
It's a very clever entry mechanism. It protects you. Let's say you want to buy. You've had your dip on the daily chart, but you don't know if the dip is over. It could keep dipping. It could turn into a crash.
You don't want to catch a falling knife?
You never want to catch a falling knife. So instead of just buying, you place a buy stop, order one tick above the high of the previous day.
Okay, so if yesterday's high was $50, I put an order in the system to buy at $50.01.
Exactly. Now, if prices start to rally today and hit that level, your order gets filled. You're in. The market has proven to you that it is turning up. You are moving in the direction of the tide.
But what if the price keeps dropping today? What if it goes down to $48?
Then your order at $50.01 doesn't get filled. The price never touched it. You never bought. You saved yourself from catching that falling knife.
So what do I do then?
At the end of the day, you look at the new high. Maybe today's high was only $49. You just lower your buy stop to $49.01 for the next day. You keep trailing it down day after day until the market actually turns and catches your order.
That is a safety mechanism built right into the entry. I really like that. It prevents you from guessing the bottom. You force the market to come to you.
Exactly. You let the market verify the turn before you put your money in. You aren't predicting, you're reacting to a confirmed reversal. This technique alone saves traders so much money because it keeps you out of so many losing trades that just keep dropping and dropping.
Now, in the new edition of the book, Dr. Elder also talks about the impulse system. It seems simpler than triple screen. It's more visual, right?
Yes, it's a color-coded system he developed. It's basically a censorship tool. He wanted a way to look at a bar chart and instantly know if he was even allowed to trade. A quick glance.
So red, green, and blue bars, how are they calculated? What's under the hood?
It combines two indicators, the EMA, the exponential moving average for inertia or trend, and the McED histogram for momentum or power.
Okay.
If both the EMA is rising and the MACD is rising, the bar is colored green. The system is screaming up, all systems go. If both are falling, the bar is red, the system is screaming down, full stop.
And if they disagree?
If they disagree, one is up, one is down, the bar is colored blue, neutral, caution.
And the rules for trading this, they must be simple.
Dead simple. Never short a green bar. Never buy a red bar. You can trade on a blue bar, but you have to be careful. It's a way to prevent yourself from doing something stupid, like shorting a stock that has massive upward momentum.
It's like a traffic light that keeps you from driving into oncoming traffic. It stops you from acting on impulse, hence the name.
Right. It forces you to respect the momentum. If the bar is green, the bulls are running. Do not step in front of them, no matter how clever you think you are.
Okay, so we have our indicators for the crowd. We have our system with triple screen. Now, let's talk about what we are actually trading. Segment 3. The what? Trading vehicles.
Choosing your weapon.
Right. And Dr. Elder makes a really important point that a chart is a chart, but the risks underneath are totally different depending on what you are trading. Let's talk about options first. A lot of retail traders love options because they seem cheap to buy.
Oh, yeah.
You can control a lot of stock for a little bit of money.
They're cheap to buy, but they are very, very expensive to lose. Elder calls options a triple complexity game, and I love his analogy here. He says trading stocks is like hitting a target. You aim, you shoot. It's relatively straightforward.
Okay.
Trading options is like trying to toss a ball through 3 moving rings.
3 moving rings. That sounds almost impossible.
It's incredibly difficult. Here's why. To win in stocks, you just need to get the direction right, up or down. That's one ring. In options, you need the direction right. But you also need the speed right. It has to move fast enough to overcome the time decay. That's the second ring.
Theta.
And you need the time right. It has to happen before your option expires. That's the third ring. If you get the direction right but the time wrong, say the stock rallies the day after your option expires, you lose 100% of your money.
That is a very sobering way to look at it. You could be completely right about the stock and still lose everything on the trade.
It happens all the time. He distinguishes between buying options and writing or selling options. He says buying is often a hope trade. It's the amateur's lottery ticket. You put down a small bet hoping for a huge payoff.
And writing.
Writing options, where you act like the casino, is where the professionals often are. You collect the premium. But writing carries its own massive, massive risks if you don't know what you're doing, especially naked writing, where your downside is theoretically unlimited.
Yeah, naked option writing sounds like picking up pennies in front of a steamroller. One wrong move and you're flat. What about futures? He calls the margins in futures honest money. What does that mean?
It's a comparison to stock margin. In stocks, when you buy on margin, you are borrowing money from the broker and you're paying interest on that loan.
Right, it's debt.
It's debt. In futures, the margin isn't a down payment, it's a security deposit, a good faith deposit. You don't pay interest on it. In fact, if you put up T-bills as collateral, you can even earn interest on your collateral while you trade.
That sounds great. But futures have this reputation for blowing people up. Why is that?
Because of one word, leverage. That security deposit is tiny compared to the size of the contract you control. You might control $100,000 worth of corn or gold for just $5,000 cash.
That's a huge multiplier.
It is. Now, think about the math. If corn moves just 5% against you, which is a normal weekly move, that represents a $5,000 loss on the contract value. Your entire $5,000 deposit is gone instantly.
Poof, wiped out. And if it drops 10%?
Then you owe the broker another $5,000. You can lose more than you started with. That's the nightmare scenario.
So it's not for beginners.
Elder calls futures traders adrenaline junkies. The leverage seduces amateurs. They see the potential for massive gains, and they completely ignore the risk of ruin. And you have to remember, Futures are a zero-sum game, actually, a minus-sum game. For every long, there is a short. You are trading directly against someone else who thinks you are wrong, and usually that someone else is a commercial hedger like a farmer or a massive institution with way better information than you have.
So tread very carefully. Don't touch futures until you are a master of stocks, and briefly, ETFs.
Exchange-traded funds, baskets of assets, generally safer, good for tracking sectors like technology or energy. But he does warn about the leveraged ETFs, the ones that promise 3x bull or 3x bear.
I see those everywhere.
They're fine for a day trade, maybe, but for long-term holds, they degrade over time due to the math of daily resetting. They lose value in a sideways market. So for long-term trends, stick to the standard ETFs.
Right. Okay, let's move to what I think is the most critical part of this entire discussion. Segment 4, risk management. Dr. Elder calls this the survival kit.
And honestly, if you tune out everything else we've said today, listen to this part. Because you can have a perfect system, you can be a genius at reading charts, but if you have bad risk management, you will go broke.
It's not a possibility.
It is a mathematical certainty.
He starts by correcting a misconception. He says trading isn't a zero-sum game. It's a minus-sum game.
Okay.
Why the distinction? What does that mean?
Right. In a friendly poker game with your buddies, if I lose $100, you win $100. The total money on the table stays the same. That's zero sum.
Okay.
In trading, there is a rake. The house takes a cut. You have commissions, and more insidiously, you have slippage.
Slippage. That's the difference between the price you see on the screen and the price you actually pay.
Exactly. You see a stock at $50, you hit market buy, you get filled at $50.10. That 10 cents is gone. It didn't go to another trader. It went to the market makers, the floor specialists. It's the cost of liquidity.
And it works on the way out, too.
It works on the way out, too. Then when you sell at the bid, losing another 10 cents. Elder says this is a constant drain on your account. The entire industry is designed to suck money out of your account.
Feeding the wolves, as he puts it. So because of this drain and because the odds are tough, we have to be defensive. He draws a distinction between businessman's risk and loss. What's the difference there?
This is a huge mindset shift. A businessman's risk is a calculated cost of doing business. A shopkeeper buys inventory. Some of it might spoil, some might get stolen. That's a cost, it's expected, it's small, you handle it and move on.
Doesn't put you out of business.
Not at all. A loss, on the other hand, is something that damages the soul of the account. It's a hit so big you can't recover from it easily. It changes your lifestyle. It wakes you up at 3 a.m. in a cold sweat.
And to prevent that capital L loss, we have the 2% rule. This is what he calls the shark bite protection.
The golden rule of trading. You must get this tattooed on your brain. Never risk more than 2% of your total account equity on any single trade.
Okay, let's do the math on this because I think people get it wrong all the time. They think it means if I have a $50,000 account, I could only buy $1,000 worth of stock.
No, absolutely not. That would be incredibly inefficient. You'd never make any real money. It refers to the amount of money at risk, the amount you will lose if your stop loss gets hit.
Walk us through the calculation. Let's make this crystal clear for everyone listening.
Okay. Get out your mental calculator. You have a $50,000 account. 2% of that is $1,000.
$1,000. Okay.
That is your maximum allowable loss for this trade. That is your budget for being wrong. Now, let's say you want to buy a stock at $50. You look at the chart and you decide your stop loss needs to be at $48, maybe below a support level.
Makes sense.
So your risk per share is $2. $50 entry minus a $48 stop.
$2.
So how many shares can you buy?
I have a $1,000 risk budget. My risk is $2 per share. So 1,000 divided by 2 is 500 shares.
Correct. You can buy 500 shares. Now let's look at the position size. 500 shares at $50 each costs $25,000.
Wow, okay.
So you are investing $25,000, half your entire account, into this one stock. But your risk is only $1,000, or 2%.
That is a crucial distinction. It ties your position size directly to your stop-loss distance.
Exactly. It forces you to think about the exit before you even think about the entry. If your stop has to be very wide, say it has to be $10 wide for technical reasons, you have to buy fewer shares to stay within that $1,000 limit. It's a self-correcting safety mechanism.
So it prevents the shark bite.
It prevents that one disastrous trade that wipes out 30% of your account. If you follow this rule, a loss is just a small bite. It hurts, but you don't bleed out. You live to trade another day.
But then there's the other danger. It's not just sharks. There are the piranhas.
Ugh, the piranhas. These are the small losses. The $200 here, $300 there. They don't hurt much individually. You think, oh, it's just a scratch.
You brush it off.
You brush it off. But if you have a losing streak, and everyone does, even the pros, they strip the meat off your bones. Before you know it, you're down 15% from 1,000 paper cuts. This is where the 6% rule comes in.
How does that work? This is an account level rule, right? Not a trade level rule.
Yes. This is your monthly stop loss. The rule is this. If your total monthly losses plus the open risk in your current trades reaches 6% of your starting monthly equity, you must stop trading.
You just stop, like, for the day.
No, for the rest of the month. You shut it down, you flatten your positions, you close your platform, and you walk away.
That sounds extreme.
It is extreme, but it's a lifesaver. This does two things. Mathematically, it caps your drawdown. You cannot lose more than 6% in a month. But psychologically, it is even more important. It forces a cooling off period.
Because when we lose, our first instinct is to fight back, to make it back.
Exactly. When traders start losing, they usually try to revenge trade. They double down to make it back quickly. They get emotional. They get angry at the market. That's how accounts die. The 6% rule forces you to step back, break the losing streak, and analyze what is wrong.
Yeah, so you can ask, is it me or is it the market?
Right. Are you out of sync with the market? Is your system broken? Or are you just having a string of bad luck? You figure that out while you are safe on the sidelines, not while you are bleeding money.
It's like the circuit breaker they have in the stock market. It just stops the panic.
Exactly. It saves you from yourself. And most of the time, that's who you need saving from.
I love the visual he uses for this whole concept, the iron triangle of risk control.
Yes, it's a great mental model. Imagine a triangle. Corner 1 is your maximum dollar risk. That's your 2% number.
Okay, my $1,000.
Corner 2 is your risk per share. That's defined by your technical chart, where you place your stop, your $2. Corner 3 is the number of shares. And here's the key. You can't just pick all three numbers. The first two dictate the third. You don't choose how many shares to buy based on how much money you want to make. The math tells you. I can risk $1,000. My stop is $2 wide. Therefore, I must buy 500 shares.
It removes the emotion and the greed from position sizing.
Completely. It makes it purely mathematical. That's incredibly freeing. You aren't guessing. You're executing a formula.
So, we've covered the system and the risk. Let's talk about some practical details in segment 5. Setting stops. Dr. Elder is pretty firm on this. Stops are not optional.
Say no to wishful thinking. A trade without a stop is a gamble, plain and simple. But he makes a key point. Stops must be tied to market structure, not your wallet.
What does that mean? Not your wallet.
It means you don't place a stop at a certain level just because that's how much I'm willing to lose. The market doesn't care about your wallet. It doesn't care about your risk tolerance.
It's going to go where it's going to go.
Exactly. If you place a stop too close just so you can trade a bigger size, you'll get stopped out by random noise. That's a soft stop, and the market loves to hunt those. You need a hard stop based on a clear support or resistance level. It should be at a price where if the price hits it, your entire trade premise is actually proven wrong.
So if support is at $48, don't put your stop at $49 just to save money. Put it at $47.90. If it breaks 48, the support is gone, and you should be out anyway.
Exactly. And if that makes the risk per share too high for your 2% rule,
You buy fewer shares.
you buy fewer shares, you adjust the size, not the stop.
And what about taking profits? This is always the hardest part for me. Greed kicks in. You see green on the screen, and you just want more green.
Elder's power word here is enough. You need to define what is enough before you even enter the trade. He suggests using channels or envelopes around a moving average.
Like Bollinger Bands.
Similar idea. These are lines drawn parallel to the moving average, maybe 5% above and below. They contain about 95% of the price action. If the price hits the upper channel line, it is statistically overextended. The rubber band is stretched. That is the time to take profit.
Don't get greedy.
Don't hope for the moon. Take the money when the market is handing it to you. That's how you get paid.
Enough. I'm going to write that on a Post-it note and stick it on my monitor. He also talks about the A trade. What's that about?
This is about scanning and quality control. You shouldn't take every trade that looks just okay. You should have specific written criteria for what a perfect trade looks like for your system. A high-quality setup. He calls that the A trade.
And if you can't find one?
If you are scanning the market and you can't find an A trade, you don't settle for a C trade just because you want action. You wait. being out of the market is a position. It is a valid strategic choice. Sometimes the smartest trade is no trade at all.
Which brings us to the final piece of the puzzle. Segment 6. The thing that nobody wants to do but everyone needs to do. Record keeping.
The secret weapon. The unsexy truth. Elder says, show me a trader with good records, and I'll show you a good trader. It is the single best predictor of success. Better than your IQ, better than your reaction speed, better than having a Bloomberg terminal.
Why is it so important? Is it just about taxes or something?
No, it's about psychology. It's about learning. Because our memory is a liar. We remember our wins as brilliant insights. I knew it was going up. We remember our losses as bad luck or, oh, the Fed said something unexpected.
We rationalize.
We edit our own history to make ourselves look better. Without objective records, you cannot learn. You are just spinning your wheels, doomed to repeat the same mistakes over and over again.
He breaks this down into 3 pillars. Let's run through them. Pillar 1, daily homework.
This is your pre-flight checklist, your routine. Reviewing the markets, checking the economic calendar, running your scans for 8 trades, it anchors you. You don't just show up at the opening bell and start clicking buttons. You prepare. You act like a professional surgeon scrubbing in before an operation.
Pillar 2, the trade plan. He calls it the trade bill.
Like a way bill for a package. You write this out before you enter the trade. What are you buying? Why are you buying it? What is the setup? Where is the stop? Where is the profit target? What is the risk?
And he has that scoring system.
He even suggests a trade APGAR score, like the score doctors give a newborn baby to check its health. You rate the quality of the trade on several criteria. Is the trend good? Is the risk-reward good? Is the setup clear? If the score is low, you toss the plan in the trash. You don't take the trade.
Writing it down creates a contract with yourself. It makes it real.
Exactly. It prevents impulsive trading. If you have the urge to place a bet, but you force yourself to stop and fill out a form first, that urge to gambling trade often just passes. It slows you down, which is almost always a good thing.
And pillar 3, the trade journal. This is the post-game analysis.
This is where the real learning happens. You document the entry and exit prices. But the most valuable part is what he calls the post-trade analysis. He suggests returning to a trade 2 months after you closed it.
2 months later. Why wait so long? The trade is over.
To remove the emotion. 2 months later, you don't care about the money anymore. The joy of the win or the sting of the loss has faded. You can be objective.
So what do?
You pull up the chart. You mark where you bought and where you sold. You see the trade in the middle of the chart. You can now see what happened after you sold. Did you sell too early and miss a huge run? Did you hold too long and give back all your profits? Was your initial read of the market correct?
You get honest feedback from the market itself.
You get perfect, unbiased feedback. This feedback loop is how you become your own teacher. If you don't do this, you are doomed. You will never, ever improve.
That is powerful, being your own teacher, because eventually the guru isn't there. The book is closed. You have to rely on yourself. So let's bring this all together. We've covered a lot of ground today.
We really have.
We started with the crowd, the indicators, the officers and soldiers. We learned to read the tide before we do anything else. Then we built a machine, the triple screen system, to filter out noise and trade with that tide using the factor of 5. We picked our vehicles carefully, avoiding the triple complexity of options or the leverage trap of futures unless we are truly, truly ready. We insured the car with the 2% and 6% rules to stop sharks and piranhas from destroying our capital.
The survival kit.
And finally, we committed to keeping the logbook, the records that separate the professionals from the amateurs.
It's a complete ecosystem. And if I can connect this to the bigger picture one last time, Dr. Elder often says that financial trading is, at its core, a test of character.
It's not about being smart.
It's not really about the charts. The charts are just a mirror. They reflect your own discipline or lack thereof. It's about cultivating that discipline. Can you follow your own rules when the pressure is on? Can you take a loss without getting angry? Can you take a win without getting arrogant and reckless?
Managing the inner game.
Exactly. The goal isn't excitement. If you want excitement, go to Vegas or jump out of a plane. The goal of a professional trader is a steadily rising equity curve. Boring, steady, disciplined growth. That is what a professional looks like.
That is the perfect note to end on. Trading shouldn't be a thriller movie. It should be a boring, profitable business. Hopefully, you all have a much clearer picture now of the machinery of the market. It's time to take these tools and start building your own practice. We have really enjoyed unpacking this with you.
It's been a pleasure.
Thank you for watching. Please like, share, subscribe, follow up the next video.